Jamie Dimon, the CEO of JP Morgan Chase, recently came out and said that he would not be a buyer of Treasuries at 4.2%, saying that fixed income is not attractive at these levels. And given his track record for the last couple of times he has made a comment like this, it does not bode well for investors in Treasuries. And if history plays out similarly, we should expect to see a large spike in yields on government bonds from here. The big question is why, and what can you do to your cash in the meantime to protect it? If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get high returns while limiting their risk by learning how markets actually work. And for times just like this, when interest rates are doing crazy things, there's no better time to learn how it works so that you can profit and protect your portfolio. Link is in the description below. The first thing that we have to take into account is inflation right now, which recently we saw that the inflation rate meant that real income dropped by the most since 2010. Now, it's true that most people have been getting pay raises for the last couple of years, but they have not met the rate of inflation. And so, for example, if you make $100,000 and you get a raise of 4%, you are now making $104,000. But over that same time frame, if the inflation rate was 5%, that means it now costs you $105,000 to get the same amount of stuff you used to be able to get for only $100,000, which means that even though you got a pay raise in nominal terms, in real terms, once you adjust for inflation, you actually got a pay cut. Now, obviously, this isn't the employers that's giving you a pay cut. The employer gave you a pay raise, but it's actually the US government giving you a pay cut by taking more of your hard-earned money through inflation, which is in addition to everything they take from you outright through taxes. The real numbers come in at $74,580 for the median income, which is a drop from $76,330 in 2021. This was a 2.3% drop in real incomes. This was the largest drop since 2010. And most importantly, this was the third straight year of real incomes declining. Sticky inflation is one of the factors that leads to interest rates going up. Even though in 2021, we started to see signs of inflation, many investors and many lenders didn't believe it would stick around. They were willing to lend for 10 years or 30 years for mortgages or other forms of debt at much lower interest rates than people like myself thought was wise. And also for savers, because savers are lenders. Your money goes into a bank, they owe you that money, so you're lending it to the bank, and then they lend it out. The interest rates on cash were abysmal because, again, the market didn't believe that inflation would stick around. So just because the inflation rate right now is, let's say, 9%, if I loan to you for 10 years at 3%, that's fine because the inflation rate will come back down in between now and when the debt is due, and I'll still make a positive return. But the year is now 2023 and it's coming to an end, and most people think that inflation is going to be sticking around for much longer, driving rates higher. One of the factors that could make inflation much more sticky right now is oil prices. It is true that ever since June of 2022, oil prices have been dropping from their peak, but that coincides with the recent draining of the strategic petroleum reserves. Basically, Biden's choice to flood the market with oil from the strategic reserves pushed the oil prices down. But the drain of the SPR has since reversed. And as a result, over the last couple of months, the drop in the price of oil has also flatlined. We've already seen a significant rise in energy prices as a result, and especially if the SPR starts to get refilled from here, we could see oil prices move much higher, contributing to higher prices in energy around the globe. Now, I think it's really important that we get into what Jamie Dimon said about fixed income prices and that rates are probably moving higher from here. If we're going to pay attention to anybody about interest rates and yields on bonds and treasuries, it's probably Jamie Dimon, maybe the most powerful banker in the world, second maybe to Jerome Powell. But first, let's take a look at what the market is telling us about treasuries. Number one, we're seeing wealthy families actually piling into bonds right now, in addition to private equity, and they're shedding stocks. Now, this is family offices, and family offices are the ones who manage the wealth of the ultra high net worth individuals. A survey from Citigroup showed these wealthy investors were loading up on on bonds and private equity while selling stocks during the first half of the year. This is clearly a contrarian move, as during the first half of 2023, we've seen a pretty strong bull market in stocks. In my opinion, this is being driven primarily by retail, and retail is going to be the ones left holding the bag here. So it's true that wealthy and ultra wealthy individuals are investing in bonds, but what is not being shown here is that a large percentage of this is private debt. There's been a growing trend where big money is investing in private credit. So no, this is not a win for treasuries. This is yet another sign that is looking bearish for treasuries. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. One alarming trend is that we're seeing treasury bills being a huge hit with retail investors. Typically what you see is that the retail investor, small money, is going to be doing things at the wrong time or investing in the wrong things. So seeing retail pile into T-bills is not something you'd want to see if you were bullish on that. But as always, we have to look at the details here to see what's actually going on. So first, we absolutely have seen a big increase in retail interest in T-bills. But it's not just retail here that is piling into short-term government debt. We're seeing corporate treasurers pile into T-bills as well. In addition, asset managers are piling into T-bills, especially considering that the 6-month T-bill yield is higher than the S&P 500's current earnings yield. And then finally, we have money funds rushing into T-bills as well. What we're seeing here is an equal growing interest in investing in T-bills from retail and big money alike. The reason is because right now that is one of the lowest risk places to get a real return on your money. As we spoke about earlier regarding your inflation and your income, you want to make sure that your pay raise is larger than the inflation rate so that you're actually making more money. The same thing is true when you're investing. You want to make sure you're making at least the rate of inflation so that your purchasing power is actually growing. Now, obviously, the larger the return, the more risk you're going to be taking on. And with debt, there's two specific forms of risk that you have to pay attention to. Number one, what is the risk that you're not actually going to get repaid the principal? If I loan you $100 and you have a big habit of skipping town, then I might charge you, 100, 200% interest because my risk of not getting repaid is extremely high. The more certain I am that you will repay me, the more willing I am to take a lower interest. But the second form of risk is like a liquidity risk. It's what if I need the money before you are going to pay me back? This is a big issue with banks right now because if everybody goes and withdraws their money from banks, well, banks have to sell all their assets, but all their assets are their debt, and that debt is worth less than what it was when the banks bought it. And so if they're forced to sell the debt prior to maturity, then they're going to take a loss. But when you're talking about debt that matures in 4 weeks, 8 weeks, 13 weeks, or 17 weeks, well, you don't really have that risk of forced liquidation at a lower price than what you bought it for. This is such a short time frame that push comes to shove and you need the money, many times you're going to be able to wait until maturity. Add that to the fact that the current rates for 10-year government treasuries, 20-year government treasuries, or 30-year government treasury yields are way below those short-term yields at just a couple of weeks. This is called an inverted yield curve, where the debt at the short end of the curve has way more attractive yield than the debt at the long end of the curve. And this is exactly what Jamie Dimon was talking about when he said fixed income is not attractive here, saying that he would not be a buyer of 10-year treasuries at 4.2%. He said he wouldn't even be surprised to see treasury yields hit 5.5%. Seeing the 10-year hit 5.5% would take it to levels that it hasn't been since 2000. Now, if you've seen my recent videos, you know that I think it's very likely we see a re-steepening of the yield curve, like we always do during or after recession. But this time, it's more likely than not to happen from the long end of the curve going up rather than the short end of the curve going down. Part of the reason for this is because of embedded inflation pressures like energy prices going higher, meaning the Fed is much less likely to drop short-term rates back down lower to 2, 1, or 0% like they have in the past. Otherwise, it could reignite inflation. We also know that government borrowing is going nowhere but up, and it's doing that very quickly. While the short-term rates have a cap on them because of the reverse repo facility until that is drained, long-term do not, which means that any government borrowing at the longer end of the curve is set to push yields there much higher. By the way, guys, I'm doing a silver giveaway, hundreds of dollars worth of silver for the Silver Symposium in Vegas from September 29th through October 1st. First place prize is getting this 10-ounce silver round. It's an Australian kookaburra, beautiful 10-ounce piece here. Second place gets this 10-ounce bar, not as pretty, but it's still 10 ounces of silver, so hundreds of dollars here. Third place prize gets this 1-ounce silver round. It's plated with gold, and it has this nice little Bitcoin design stamped into it, so pretty cool. So what do you have to do to get the prizes? Number one, you have to sign up for the event with the ticket link in the description below. Number two, you have to meet me in person. The first person who signed up with my link, who meets me there in Vegas, gets this first place prize. Second person to meet me gets the second place prize. Third person there to meet me gets the third place prize. So get your tickets in the link below. Just a couple of weeks left. Can't wait to see you there and give away these silver prizes. But what about Jamie Dimon's track record here? Has he said anything like this in the past? And if so, how did that pan out? First, let's take a look at what Jamie Dimon said in December of 2020, just about 3 years ago. He said that he wouldn't touch treasuries with a 10-foot pole at these rates. We can see in December of 2020 that the 10-year government treasury bond was yielding under 1%. And obviously over the last 3 years, it has surged higher. And anybody who had bought a 10-year bond at that time would be sitting on a massive pile of unrealized losses right now, aka a lot of banks. So he was clearly right about it at that time when he said, I wouldn't touch it with a 10-foot pole. He was right. Prices of bonds collapsed. Those yields went much higher. But even that wasn't the first time he had made that bearish call on bonds. Back in 2017, in August, Jamie Dimon said, I wouldn't buy a 10-year bond from any country in the world right now. In August of 2017, the US government 10-year bond yield was about 2.2%. Very shortly after, over the next year, these rates skyrocketed up to 3.2%. What is the common denominator between these three time periods? Right now, December of 2020 and the end of 2017 through the end of 2018. Fed tightening. In 2017 through 2018, the Federal Reserve, led by Jerome Powell still at that time, was tightening, draining their balance sheet and raising interest rates. Now, they obviously reversed course at the end of 2018 during the taper tantrum when the market almost collapsed as a result, and they pivoted. But there was no inflation at that time, so they had no excuse to keep tightening. If their tightening was going to cause the market to collapse and there was no inflation they were fighting, they had no excuse to keep on going with that. So they pivoted. And at that time, that pivot didn't cause any inflation. Fast forward to December of 2020, and we come right in the middle of the Federal Reserve's easing, printing trillions of dollars, keeping rates low, the government bailout of the entire economy. And it was very clear that at some point, the Federal Reserve was going to have to tighten as a result. And they absolutely did start tightening much more and much longer than anybody expected, which has sent yields surging higher since. And Jamie Dimon is basically saying that's not done. Financial conditions are getting tighter. He's saying, yes, the economy is doing great right now, but it would be a huge mistake to believe that it'll last for years. One of his top concerns is the reining in of liquidity programs by central banks through things like quantitative tightening. In addition to the Federal Reserve's quantitative tightening, where they're draining their balance sheet and raising interest rates, they're also tightening in other ways, especially by imposing new regulations on banks as a result of some recent bank failures. Jamie Dimon said these are hugely disappointing and that they're going to have to hold about 30% more capital than European banks. This itself will reduce liquidity in the markets and cause more tightening to happen, higher rates. And if you haven't put 3 and 3 together right now, all these things add up to some massively bearish pressures on markets, both stocks and bonds. And when bonds drop, rates surge. So I think Jamie Dimon nailed it with this one. It does look like from many points of view that interest rates on debt are about to surge higher from here, which means that right now I'm not a buyer of long bonds. Doing something like putting your money in a money market to capture those short-term yields, or even doing like a T-bill ladder, that won't expose you to that risk. You'll get the advantage of those higher yields and you won't have to take on the risk that you'll be forced to sell before maturity because there's such short time frames. But anything longer than a couple of months is just too large of risk in my opinion for too small of a return. And there's much more where this came from. For all members of Heresy Financial University, new course dropping soon on cash management, teaching you all the different ways where you can maximize the yield you're getting on your savings part of your portfolio without taking on extra risk like bank failure and bail-ins and things like that. Link on that is in the description below. As always, thanks so much for watching. Have a great day.